Hey folks, aside from the usual topics that preppers like to talk about, one of the most common or most popular subjects here lately, anyway, has been inflation. I've had a lot of videos on it myself, and you're right. This is going to be another one of those. Yesterday, the Fed announced it was hiking the interest rate by another 75 basis points. That's for the fourth straight meeting in a row. Now, there's an article here that I want to read a little bit from you because it says a little bit about their thinking, or at least what they are telling people that they're thinking. The Federal Reserve on Wednesday raised its benchmark interest rate by 75 basis points for the fourth straight month as it struggles to bring runaway inflation under control, a move that threatens to further slow U.S. economic growth and exacerbate financial pain for millions of households and businesses. The three-quarter percentage hike in June, July, September, and November underscored just how serious Fed officials are about tackling the inflation crisis after a string of alarming economic reports. So for at least four times, I thought it was more than that, but for at least four times in a row, they've raised the interest rate. The move yesterday, which was expected, brought the federal funds rate to somewhere between 3.75 and 4%. It's the highest since before the 2008 financial crisis, from near zero at the beginning of the year. Actually, in this article, it does say it marks the sixth consecutive rate increase this year, and puts interest rates in firmly restrictive territory. So I've talked about how the Fed has been extremely aggressive in hiking interest rates in an effort to slow the economy and reduce inflation. I've also mentioned how I don't think it's going to be possible for them to do that. I don't think anything that they're going to do is going to have any effect on inflation. There are a couple of... I'm going to read some more of this article because there's a few things in here that I think are key to understanding what's going on. And as always, links will be in the description below. Links to the articles will be in the description below. So, skipping down a little bit in this, excuse me, in this article, the committee anticipates the ongoing increases in the target range will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time, the Fed said in a new sentence added to its post-meeting statement. Officials noted that they will take into consideration the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity, and inflation and economic and financial developments when determining how high to raise rates in the coming months. The statement shift comes amid increased uncertainty about the health of the economy. Inflation remains painfully high and the labor market is still abnormally tight, but both the housing and manufacturing sectors are weakening. Now again, I talked about this in a recent video about how manufacturers, companies were starting to look at streamlining businesses, laying off people, or at least reducing the amount of job openings available, which would result in spreading the workload among the existing employees. I'm seeing that happen at my own job. I told you folks about it, how we've laid off a handful of people. We're moving some other people around, and we're shutting down one of the production lines at my plant. all due to the economy and how it's cheaper now to get the part that was made on that line from Germany shipped over here than it is to actually make it here in the U.S. Now there, I heard some scuttlebutt, some rumors, and again I haven't had it confirmed yet, but I heard rumors that they shut down another line today, not permanently, but just for like the day. But it made it sound like a lot of the employees were talking about they were going to have to move around. So I've got to ask around and see what more I can find out. But it looks like there might be some more changes going on at my job, which is what I expected. They indicated that in the meeting they had with me that there would be more layoffs, and I'm fully expecting it. And this might be just a temporary one day or shutdown for lack of parts, or it could be an indication that they're fixing to pull a team off of one of the other lines and split it up among other areas as well. All right, but I've gotten off track. Get back to the article. Skipping down a little bit further, I've said at the last two press conferences that at some point it will become appropriate to slow the pace of increases, Chairman Jerome Powell told reporters during a press conference in Washington. So that time is coming, and it may come as soon as the next meeting or the one after that. No decision has been made. Powell later added that it is premature to think about pausing interest rate hikes, noting that considering the lag in monetary policy does not mean Fed officials are prepared to stop raising interest rates. Now that's key right there. Let me read that one again. Powell later added that it is premature to think about pausing interest rate hikes, noting that considering the lag in monetary policy does not mean Fed officials are prepared to stop raising interest rates. And the next quote is, "Let me say this," he said. "It is very premature to be thinking about pausing. When people hear lags, they think about pauses. It's very premature, in my view, to talk about pausing our rate hikes. We have a way to go." All right, so that also links back to another video of mine where I mentioned that the Fed is notorious for being slow to react and not seeing what's coming. What they'll do is once they get on a trend of either raising or cutting interest rates, they will keep doing it. And what you have to understand is when these rates go up or they're cut and they go down, there's a lag time between when these rate changes take effect and when you actually start seeing the effect in the economy. There's a lag time of at least 3 months or so, possibly as much as 6 months. Another example of that would be all of the stimulus spending by the Biden administration. All these $1 trillion bills that were passed, a lot of that money is still not in the system. It's just sitting there waiting to be spent. A lot of it's been spent. A lot of it's been earmarked for spending, but some of it's still just sitting there. And even the stuff that has started to be spent, it takes time. You have to look at the money in the market and in the economy as flowing like a river. It takes time for something upstream to affect downstream. So when you start making a bunch of changes upstream, there's a delay. It can take time for the effects to be seen downstream. And this right here is a perfect example of them not stopping momentarily just to observe what changes are taking effect from their rate hikes. Anybody with any sense would say, okay, we're going to hike rates a little bit. And once you've done that, all right, we're going to wait. We're going to see what happens. And then if we need to raise it some more, we will. That's not what the Fed does. The Fed raises rates, and they automatically start talking about raising them again at the next meeting before they even know what effect it's had. And within 2 or 3 days or a week or two, if the numbers come out for the past month showing inflation still at high, they'll go ahead and raise rates again, knowing that the first rate hike hasn't quite taken effect yet. The effect hasn't been seen yet. So it's like they're building up pressure on the economy, but they're not observing it to see how that pressure is affecting it. They just keep adding more and more and more. The result is going to be that all of a sudden, all that's going to break loose. You're going to see the economy get choked down severely, and all of a sudden they've got to suddenly pivot and start cutting rates, but by then it's going to be too late. That's what I believe is going to happen. And right here, Powell has said that it's premature to think about pausing interest rate hikes. He doesn't even want to think about pausing long enough to see what he's done. All he can see is it hasn't had an immediate effect, so he's going to keep on doing it. So there's one other part of this article that I want to quote. And it's, here we go. It's too hard. Thomas Phillipson, a University of Chicago economist and the former chair of the White House Council of Economic Advisors, told Fox Business, "It's not that the Fed is not capable. It's just that it's impossible to do. It's like planning a wedding on a sunny day next summer. You can't forecast the weather, and you can't forecast the economy." So, here again, this economist is saying the very same thing I was saying in a different way. The Fed is continuing to build up all of these rate hikes with the intention of cooling the economy down and pushing inflation down to 2%. And they're ignoring the risk of their actions pushing the economy into a recession. Now, I'm not going to even get into the fact that I already think we're in a recession. That's my personal belief based on what I've seen and based on the traditional definition of what a recession is. And I'm not going to get into the fact that the current administration is trying to change the definition of what everybody has gone by. So, but again, this economist is basically saying the same thing. The Fed is trying to forecast and control, and they're not going to be able to do that. It's not within their power. They have minimal effect on the economy. I mean, there's only one way really that they can. Well, actually, there's two, but there's only a couple of ways that they can affect the economy. A vast majority of it has to do with consumer sentiment, government spending. All the Fed can do is either tighten or loosen money by either increasing or reducing the interest rate, or they can do like they did back in 2008, and they can buy debt, basically. It's essentially what they were doing. They were buying debt in order to try to keep banks solvent. That's a whole nother issue with the Fed right now. All right, the next article that I wanted to talk about kind of follows up on all of that. The title is "The Countdown to a Recession Has Officially Begun After More Accurate Yield Curve Indicator Turns Negative." All right, now, for at least 2 times now in the past year, the 2-year and the 10-year yield curve inverted. I believe there's at least 2 times, possibly even a third. But there's another metric that's used to indicate a recession. And usually when these yield curves invert, basically what it means is the 10-year yields less than the 2-year. And usually it's the other way around. The 10-year would usually yield more. But when they invert, that's usually an indication that there's going to be a recession within. Some people say 6 to 12 months. Some people say 12 to 18 months. A lot of it just depends. It's never exact, but it's almost always accurate as far as you can expect a recession within the next year. The 6 to 12 or 12 to 18 months, that depends on who you talk to. Anyway, back to the article. The countdown to an economic recession has begun after the 3-month and the 10-year yield curve finally inverted. Research firm T.S. Lombard expects a recession to hit the U.S. economy within the next 12 months. The 3-month 10-year yield curve is important because it has historically been more accurate at predicting recessions, T.S. Lombard said. After the 3-month and 10-year Treasury yield curve inverted, according to a Wednesday note from the research firm T.S. Lombard. The inversion in the curve happens when a short-term yield of a U.S. Treasury note rises above a longer-term Treasury yield. So, like I said, a 2-year or a 2-year would yield more than a 10-year because you're holding it for a longer period of term. No, excuse me, I'm sorry. A 10-year would normally yield a higher yield because they're holding it for a longer period. You would expect to get a larger return off of it. The 2-year would be a smaller return, a smaller yield, and the 3-month would be even smaller than that. All right. The 2-year, twice now at least, the 2-year is yielding more than the 10-year, which is exactly opposite to what it normally is. Now they're saying that the 3-month yield is yielding more than a 10-year Treasury. So I'm not really great at explaining economics. I'll be honest with you. I admit that right up front, so I'm sorry if I'm confusing people. But the 3-month should yield the smallest amount. The 2-year should be in the middle, and the 10-year should be the largest yielding Treasury. That it's based, if you invest, if you're going to hold something for 10 years, you expect a larger return on that money, right? So that's all it is. Anyway, getting back to this, but according to T.S. Lombard, the 3-month and 10-year curve is significant because it has historically been more accurate at predicting recessions. The 3-month yield first crossed above the 10-year yield on October 25th and has held steady since then with an ongoing spread of nearly 10 basis points. On Wednesday, the 3-month Treasury yield rose 2 basis points to 4.15%, compared to a 10-year Treasury yield of 4.08%. On average, a recession starts 12 months after the 3-month 10-year curve inverts, but it is also taken as long as 22 months or as little as 5 months, T.S. Lombard's Skylar Koenig said. Okay, so a recession is now seen as inevitable by many, given that the Fed is on track to raise interest rates by more than 400 basis points this year to tame inflation. As a recession is often seen as the only way to truly tame inflation by destroying demand. As the Fed hike, As the Fed hikes and purposefully dampens demand to bring inflation down, the outlook for growth worsens. Thus, inversion reflects optimism that the Fed will do enough to bring inflation down, but also that tightening will mean growth falls to the point that the Fed will have to cut. Oh, sorry, it's been a long day and my insomnia is killing me. I am so sorry, folks. Alright, so, there again, that just goes to show that the Fed is going to keep raising rates until we go into a recession. And they're not going to stop until they actually see us going into a recession. By their definition, or by the Biden administration's definition, we're not in a recession right now. Normally, for the past several decades, 2 consecutive quarters of negative GDP growth is considered a recession. That's the generally accepted definition of a recession. We passed that months ago. So by that definition, we're in a recession right now. However, because employment is what they consider employment full, but unemployment at record lows, they're saying we're not in a recession. What they're not taking into consideration is that there are millions of Americans, able-bodied working Americans, that haven't returned to work. Whether it's by choice or some other reason, they just haven't returned to work. That's the very reason why there's still, even though you see record low unemployment and employment levels at all-time highs, that's why you can drive around and see now hiring signs everywhere. There's places around here where I live. There's actually one restaurant that has a sign up, now hiring, will work with your schedule. So they're going to adjust their schedule to work with you, where it's usually the other way around. I'm seeing multiple signs everywhere I go where they're hiring, and all you have to do is ask for an interview. They'll interview you on the spot. You don't have to set up an appointment or schedule a meeting. They'll do it right then and there. All you have to do is ask for a manager. So, yeah, employment may seem full, but there's a lot of job vacancies. A lot of people are not working. That is why you have the Biden administration saying that we're not in a recession, along with the fact that we're coming up, we've got another 6 days to the election, to the midterms, and they're trying to make it seem like everything's all great. Oh, Lord, I am so sorry, folks. And they don't want to highlight the fact that we're in a recession right now because it'll look bad on them. And before anybody beats me up about the Biden administration and the Democrats doing that, to be fair, Republicans would do pretty much the same thing if they were in control of the House and Senate. So, what we're looking at is just further confirmation that the rates are going to continue to go up. Pressure is going to continue to be put on the economy. There's more layoffs coming, folks. More companies are going to be laying off. More companies are going to be streamlining their business. Things are going to continue to get expensive with these rate hikes going up, and with inflation staying at an all-time high. It's not looking great, folks. On the flip side, and this will be in the link below too. I have seen articles where Walmart and Aldi are both offering Thanksgiving dinners or items used in making Thanksgiving dinner for last year's price. I don't know exactly which items that involves, which items it includes. I haven't looked at the actual articles. Like I said, it'll be in the description below. But this is in response to people's fears of not being able to put a Thanksgiving dinner on the table this year due to higher food costs. So Walmart and Aldi's will be selling some of the traditional Thanksgiving dinner items and ingredients at last year's price instead of what would normally be this year's price. So supposedly that's to help people out, but trust me, corporations don't do anything unless it benefits them. So they're probably doing that as a way to get more people in the stores to do their shopping, because early forecasts that I've heard show that this Christmas season, this Black Friday and this Christmas season, are going to be really poor shopping seasons. Sales are looking down for this year, and Thanksgiving and Christmas are always a boost for the economy. That's why you have a Santa Claus rally at the end of the year in the stock market, when companies start making all that extra money from holiday sales. So this may be to help people out, but more than likely it's just a way for them to try to boost sales a little bit in anticipation of fewer sales over the holidays. I'll let you make up your own minds as to whether or not you believe that. That's my belief anyway. So that's all I've got right now. I appreciate you guys watching. Like, share, subscribe if you haven't. I appreciate all the comments. I know I'm slow getting to some of the comments and responding to some. I don't always respond to every one of them. I try to if I can. I try at the very least to like your comments. But know that I do appreciate all the likes, all the shares, and all the comments. And I appreciate you guys watching. So for now, that's all I've got. Stay safe, take care, continue to prep, continue to stack food. Food above all. Of all the preps that you could be doing, food is the most critical in my opinion. So continue to stack food. And until next time, folks, take care. And I'll catch you later.